Welcome to another episode of Equity Mates. It is Wednesday, which means it's only one thing, and that's Watchlist Wednesday. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this Watchlist Wednesday. We've got a new favourite for the Equity Mates community,
Yes.
but someone who's had a very busy week with the Afterpay deal that we spoke about on Monday.
Yeah.
But we've managed to pull her off all of that work
Yeah.
to give us some of her time.
That's right. Was probably looking forward to a day off on Banker's Holiday, and then Afterpay drop that there are big news. But look, we are very excited to welcome Elise Kennedy from Jarden. Elise, welcome.
Thanks for having me.
So Watchlist Wednesday, as always, the formula is pretty straightforward. 3 stocks on your watch list, Elise, and why. And a reminder that this is not a buy, hold, or sell recommendation from Equity Mates. It's just to hear Elise's thoughts on all things tech, because that is what Elise is covering at the moment. So let's start at the top with Wisetech Global, ASX ticker WTC. Elise, what is the company and why is it on your watch list?
So Wisetech is a logistics software company, and it is one of our preferred picks because it taps into a large global addressable market for around $21 billion. So that offers a long opportunity for growth. We also see them as delivering around 20% organic growth is sustainable, and this will be driven by the likes of your global rollouts because they have contracts with 34 of the largest freight forwarders. Also increased module usage because they have a core module, but then you also can use others from transport to shipping to warehousing. And then lastly, the other thing is the number of acquisitions and embedding those acquisitions and starting to get better earnings out of that. Now, the thing is that's important with this stock is since it listed in 2017, it's been moving towards more of a model that is based on instead of a seat transaction license, you get to take a seat transaction license, but then you also get a clip of the ticket of when it goes from the ship to the port to the customs. Each of those is more your transaction model. And so we've seen freight forwarding volumes up over 20% on the East Coast and globally similar trends. And so that's where we think that is a core driver and a catalyst going into reporting season that should bode well for this stock. And we have seen a number of other stocks within the space report and see strong results and strong share prices. So the likes of a Descartes, which is a Canadian listed stock, and then you've also got another stock, Manhattan Associates in the US. They've both reported strong results. And same with some of the freight forwarders like Main Freight in New Zealand, also seen again a strong result, which bodes well leading into the numbers. And the last thing that I just mentioned on that as well is just around the contentious point in this stock is it did historically have some short seller reports. Now the stock trades around $30 to $32, whereas its historical high has been 38. So it hasn't ever hit back to that high because I think a number of investors are still concerned about some of the points that were raised. And that was particularly around some of the acquisitions because they did make around 40 acquisitions over 2 years. However, in this result, they haven't done any acquisitions. So we finally get to see that organic growth rate. And for us, that's really important point because can put some of those short seller reports to bed and say, hey, this is our organic growth rate. We've got a sustainable business. And later on down the track, if they do continue to pursue acquisitions, then they're in a good position in continuing that organic growth plus your acquisitive growth.
It's a fascinating one, Elise. Probably one of the less talked about wax stocks. So glad you're bringing it to our attention and giving it some airtime. But unfortunately, we don't have a lot more time to talk about it. We will move on to our second stock, and that is REA Group, ASX ticker REA. A lot of people will be familiar with the stock, but for those that aren't, can you briefly tell us what it does, and then why is it on your watch list?
As you say, a lot of us will be familiar with realestate.com. When you go and you sell a house, that's often one of the platforms that you will advertise on. So how they make their money is essentially from the number of listings that are on the portal, plus the price that they charge for that. So it's quite a simple model, which has been existent for a long period of time. Now, one of the reasons that we are positive on this stock stems from our house price view around rising house prices. So we forecast another 10 to 15% price increase in housing prices over the next 12 months, on top of the 15% we've already seen. And when you see the house price increases, there's a strong correlation with about a 3-month lag between listings volumes. So that should drive some of the top line and the listings to be able to drive that. The other component that's important to note is around the price increases. So this is one of our favorite stocks, and it's got this fantastic model in Australia in a way where the vendor pays the fee. So think if you're spending, say, $5,000 on marketing fees, that sounds high, but if you're selling your house for, say, $1 million, that's 0.05% odd of or 0.5% of the house price. It's actually not that large of a transaction cost, especially when you compare to, say, the real estate agents where they're taking 2 to 2.5%. And that could be the make or break between, hey, am I going to get two bidding prices and two bidding parties to drive up that share price. So that for us again is one of the reasons that we see this as a really strong stock leading into the results. And the last point that I'll highlight in there is just around some of the talks around stamp duty changes. Now that's predominantly in New South Wales. It remains in the air as to whether or not that passes, but that would increase turnover and bode well for this stock. So if that was to become a stronger talking point, then that again is something we think investors should be aware of that would bode well for this name.
So Elise, just on REA, one of its major competitors being Domain, where does it sit when you look at both of these companies in terms of the competitive landscape? What's your thoughts?
Over the next 12 months, they are both levered to that rising house price view. So they're both recipients and positive on them. However, the market dynamics, REA does tend to bode stronger. We saw during lockdown a bit of an acceleration in their lead when you look at some of the tracking volumes like Google Trends, or we can get some of the app downloads. And I think that comes down to a little bit of when you've got a little bit of uncertainty, are you going to advertise on both platforms? Maybe, but you're probably going to go for the one that has the market leadership. In some of the key markets like Sydney, for example, they're akin, but again, when you move into regional areas and or Queensland or WA. So a very formidable player. However, probably our preference would be slightly towards REA.
Elise, one more question quickly on REA. It's obviously dominant. Well, it's in this sort of duopoly for online listings in Australia, and it's seen some incredible growth. And you talk about the next 12 months, it'll see growth because of rising house prices. How do you think about its ability to grow beyond this core platform and this core business? Is there opportunities overseas, or are there opportunities for, ancillary services in Australia? What's, the next leg of growth for REA beyond house prices?
It's a really great question, and that's one of the advantages of REA versus, say, some of its more domestic peers like Domain, is they do have that offshore footprint. So they have Alara, which is an Indian business. They've still got a small foot in the Asian business, and then another stake in a company, Property Guru, and then they've also got a stake in a US business called Move. So all of those again create avenues for future offshore growth that perhaps isn't fully priced in today. The other component, as you mentioned, is some of these other services. So they have things like mortgages, and they've just required one of the mortgage choice operators, and what could they really do with that? How many more leads can they get? That's probably not fully factored into the market's price. And the last thing as well we mentioned is other services like Agent Match. Whether or not that can be monetized in its own right remains to be seen, or it might just be another way to help sustain those price increases looking forward.
Interesting. Well, Elise, we started with the W in wax, so we may as well end with the X with Xero, ASX ticker XRO. What is Xero for those that haven't heard about them, and why is it on your watch list?
So Xero is an accounting software stock. It's been one of my long-term top picks since $30, and it's now around 140, and we still see a runway for growth. Now, what I love about this stock is it's one got a huge again market opportunity of around $71 billion. And so that again shows you the capability for this company to grow. Now, adoption of accounting software globally is less than 20%. So that's again a driver. And the important thing is that they've shown their ability to be able to drive that adoption. So in Australia, penetration here of accounting software in the cloud space is around 60 to 70%. We're seeing similar trends over in the UK. So again, for us, that shows, hey, we can see Xero takes a very strong position in the market. They're one of the market leaders. Some of the catalysts as well to driving this adoption near term that we think is important to note is COVID showed that businesses need to have some form of cloud accounting software, to be able to work remotely, to be able to see all the financials from a distant space. So that for us is again a catalyst to driving adoption, but more importantly as well as regulation. So a lot of the uptake in Australia and why we have such high rates is some of the regulation that's here from GST making it more efficient to use a software program, but then also single touch payroll where you have to essentially pay your employees through an online channel that's been approved by the ATL. We're seeing something similar in the UK, which is driving adoption, which is called Making Tax Digital. So if you start to see those regulatory catalysts in other markets that Xero is, and they are truly global already in terms of their UNDS, they're in Canada, they're in South Africa, and Singapore, and they're continuing to grow through some of their acquisitions as well. That's an important component there. We also see the unit economics that work for this business. So margins in Australia are, over 50%, whereas internationally they're still 9%. So you think, oh, that's because they're still growing into those markets. But longer term, you should start to see those move towards more your equilibrium because accounting software, it's essentially great because it's a global language. Your debits and your credits are exactly the same no matter where you are around the globe. And so that enables you to be able to roll out that software in a similar way and create some of those opportunities when it comes to, again, the unit economics. And the last thing that I think is important to note with this stock is some of those acquisitions. So what they're doing with those acquisitions is broadening the ecosystem. So instead of just paying for your core accounting software, which can be, 20 or 10 to 20 to $50, you can add on some of the acquisitions they make from HubDoc to an e-invoicing called Waddle and another acquisition they made called Planday. So that enables more subscribers, more ARPU, potential other revenue lines, which again, all bodes well for the top line. And then again, in a cost efficient manner, because you're already tapping into those customers, you're just cross-selling to them other products.
Now, Elise, we see some big global competitors for Xero. Intuit, a $150 billion company over in the US, has QuickBooks. How do you think about Xero in relation to some of its big global competitors?
I don't think this is a category where it's a, monopoly. We see a healthy oligopoly panning out. You think about the dynamics that we just spoke about when it comes to even real estate. There's two players in there and they're quite profitable players. I think it's the same when you look at the accounting software landscape. Everyone has their preference when it comes to, phones as well. Do you use Google? Do you use Android? Apple. So I think that's where your preference of technology, it's not as though one player will win. We see Xero and other players in the space as being successful, that if anything, we don't see them as a threat, but more so growing the awareness of the category as a whole, that perhaps it can help adoption overall.
We're almost out of time, but I do have to ask one more question. We have just seen a string of New Zealand businesses come over here and do incredibly well. Xero, we're talking about. A2 Milk obviously captured a lot of headlines. Aroa Biosurgery is getting a lot of buzz. There's a number more. You work for Jardin, which is a New Zealand business coming over to Australia as well. Final question, what's in the water over in New Zealand and how are they creating so many great businesses that are coming to Australia and then taking on the world?
I can't say I know it's the secret sauce, but I could tell you I'm definitely drinking the water.
Well, Elise, thank you very much for your time. Thoroughly enjoyed you having on Watchlist Wednesday. A reminder to our audience that we do have an interview coming out with Elise where we deep dive on the Australian tech scene, and Buy Now, Pay Later coming out tomorrow on the Equity Mates Investing podcast. So if you'd like to hear much more of what Elise has to say on that space, absolutely tune in. It was a great conversation, but unfortunately that is all we have time for, Elise. So thank you very much for joining us, and we'll certainly look forward to our next Watchlist Wednesday with you.
Thanks once again.
And that brings us to the end of Watchlist Wednesday. A reminder, we had Wisetech Global, WTX, REA Group, REA, and Xero, XRO. And Ren, tomorrow we're not going to have experts, but we're going to be going through some experts and their letters, shareholder letters.
That's it. One of the most valuable sources of information for any investor are these quarterly or yearly investor letters that get released. We've pulled out 3 from Australian investors that we're going to talk about on the show tomorrow. So join us same time, same place.